And what I want people to understand is the lag effects could be a lot longer. Reason being is there was a tremendous amount of stimulus pumped into this economy, not just from COVID, but actually the last year of administration, passing the IRA Act, the CHIPS Act, and bailing out banks that were failing. This pumped in trillions of dollars of stimulus, which then rode the market up to newer highs. Hopefully everybody is doing well. We have a lot to go into today, and specifically I want to talk about divergences. What am I seeing? What's making me concerned? And the narrow breath once again back in this market. We started to see this market rally widen out, but now it's back to basically 5 names that are starting to carry this market. Now, we all thought we were pretty much past the banking crisis, but as we can see here, what was the thing that we kept talking about? It was the commercial real estate and the refinancing debts that need to come down the road here. But this week we saw New York Community Bank absolutely tank, bringing regional banks down as well. New York Community Bank was reporting serious pain in its commercial real estate portfolio, dropped as low as $5.70 and has rebounded a little bit off of that recent sell-off here. What we're seeing is a massive divergence of the top 5 to 10 names carrying the majority of this market and what's really going on underneath this market. Community banks are a huge part of our economic growth. We go to the community banks for local business loans, local real estate loans, local home loans, local car loans. And so when we're starting to see these community banks fail, understand that this is going to impact economic growth, as the consumer is not going to be able to have those regional banks anymore if they keep failing. And so that means that economic growth is going to slow because we're unable to purchase more cars, buy more properties. And so less and less banks are going to be out there earning our business, which could impact GDP down the road. And of course, we know that there is a ticking time bomb when it comes to the amount of commercial debt that is needing to be refinanced. Like New York Community Bank are telling us that there is some serious problems here. Now, if the commercial aspect of regional banks wasn't a problem enough, what are we starting to see with the consumer? The consumer is actually defaulting on loans here. Delinquencies are starting to pick up to a level where I would say we have to pay attention. When delinquencies pick up, we tend to fall into a recession. As delinquencies pick up, we can see that gray bar behind us is a recession. Take a look at where we are today. We have had a massive spike in consumer delinquencies here. Now, we still have an inversion on the 3-month to 10-year or 3-10s, pretty heavily inverted at over 130 basis points here. And as we've talked before, the inversion wasn't the scary part. What the scary part is when we get yields normalized once again, what is the repercussions of those lag effects that are coming? So to me, a lot of this market move has been a liquidity move, not necessarily a earnings per share growth and a valuation move. So with this recent market move, because of the amount of stimulus passed in this economy, I tend to think that this market is overpriced from a valuation standpoint. Now, of course, the government and feds could keep pumping money into this economy, forcing the market to go higher and higher and higher, which I do think we're approaching bubble territory and unhealthy rallying when we look at the breadth in this market really being led by 10 names. Now, most people pay attention to the 2s to 10s, and when we look at the 2s to 10s here, was inverted by over 100 basis points, and take a look at this. The inversion is actually starting to normalize. We're starting to get normalized levels on the 2s to 10s. Obviously, the 3s to 10s are still heavily inverted. And so as I'm walking you guys through this, I am going to show you some serious divergences and kind of where my mind's going when it comes down to an investment standpoint. Not only are we getting divergences on the triple Qs versus your equal weighted S&P, or the S&P versus the equal weighted S&P, but we're also getting divergences here on gold versus GDX, which is actually bringing some interest to me here. I look at contrarian ideas, and I tend to think that GDX has been a massive underperformer when we look at gold. And so if we just go over basically the last 16 years of these charts, you can see the correlation between GDX and gold here. They trade pretty much in unison. But if we fast forward to where we are today, there's a pretty big divergence taking place here. Take a look at GDX getting lower lows. And when we look at gold, gold has been in a pretty substantial uptrend here. And you could even say that this almost looks like a cup and handle pattern formulating here, which means that this could be a pretty substantial breakout. And so we're starting to see gold break out. We're starting to see the markets take off, and the bond market's saying that there's something wrong. The gold market's obviously saying that there's a flock to safety needed here. But then GDX is kind of being left, or the miners are kind of being left for dead here, which I think could be a pretty substantial catch-up trade here. We actually have a pretty tight wedge formulating here, which once again, could lead to the breakout that I'm talking about gold having. So it looks like gold's on the verge of breaking out to new highs and having a pretty substantial move to the upside. And when I look at the GDX or the gold miners itself, we can see that they are in a tight wedging formation here, and it is going to possibly be making a pretty substantial move in the very, very near future. Next up is going to be the 5-year chart of the Russell versus the S&P 500. And so once again, we can see the correlation here of the Russell versus the S&P 500, basically trading in pretty much unison. But over the last few years, take a look at the separation that has taken place due to the overweight of technology in the S&P 500, hitting home that it's been a few names carrying this market. And there's a lot of things that are pointing to an end of cycle to me. War being one of them, inflation being the second, Fed's tightening being the third, and now consumer delinquencies picking up being another major red flag to me. The last thing to kind of drop here is going to be the jobs market, which we'll get into in 1 minute. That's basically the glue keeping everything whole and really separating the true economy to the stock market. I believe once jobs get lost, we're going to see that correlation between the stock market and the true economy, possible recession, and that's when we get that substantial pullback. Now, of course, I'm not saying that this could happen because the government could step in at any point in time, stimulate in just enough time to save the world once again and print more money, and that debt time bomb that we keep talking about ticking is just going to get the can's going to just get pushed down further down the road. This is not a recommendation to buy the Russell or the S&P 500 index. This is me just showing the breadth and divergence that's been taking place over the last few years. Has underperformed. A big part of that is the fact that a big chunk of the Russell is unprofitable and or losing money. As I stated earlier, all the stimulus that was passed over the last few years, whether it's the IRA Act, student loan moratorium, the CHIPS Act, the Fed stepping in to bail out banks, pumping in that amount of stimulus has definitely led markets to newer highs. And rightfully so, as this is a liquidity machine. So if there's liquidity flowing in, the price is going to show that. But what ends up happening is valuations are getting stretched. And I think that's where we are right now, where valuations are definitely starting to approach, in my opinion, fairly close to bubble territory here. We're starting to push over a 25 PE ratio on the S&P 500. Sitting at 24.9 times earnings is very, very rich. We're talking about a 20-25% premium on this current market condition, not including any sort of bad news that can come out. Bad news meaning that our supply chain could get disrupted again. Bad news meaning that we could be going to war. Bad news meaning that China could attack Taiwan. There is a lot of political chips that could drop here that could absolutely cause this market to be well overvalued 25%, getting closer to 30 or maybe even 40% overvalued. A lot of experts are calling for right around $240 worth of earnings. And if we put a 20 multiple on that, we should be right around 4,800 by the middle to the end of this year. And we're already at 4,900 or pushing 5,000. So even from a forward standpoint and the unknown of earnings, and going off of earnings projections, we're still fairly elevated here. So as I stated before, the jobs report is kind of what's been holding this all together. The bubble gum, the glue, whatever you want to call it, the jobs report has been very, very strong. We're sitting at 3.7% unemployment rate. So what we're seeing here is unemployment is basically normalizing or stabilizing. We haven't seen that big spike up, and normally what follows with that big spike up is a recession. But what did we notice? Well, there's two indicators that are kind of pointing that there is some issues here. Obviously, yields starting to normalize. There's usually a ticking time bomb here that recession could hit. Number two is the delinquencies now picking up is definitely concerning. We're also seeing banks fail, and the amount of debt that needs to be refinanced is alarming. Really big unexpected spike in healthcare and private education. That was a 70,000 job bump in January alone, which is pretty interesting here. Don't really know what to make of that. Really, really hard to make sense of why this would tick up so drastically. The other one I want to point out is government jobs. Government jobs rose by 36,000. So government's been spending a tremendous amount of money. These are two that I really think could turn around pretty quick. So when I look at the VIX, this is a measure of complacency versus fear, and there is just no fear and a tremendous amount of complacency in here. People are piling in to get into all-time high stock market at pretty elevated valuations with almost no questions asked or no concerns with multiple wars going on, governments, banks failing, government spending, and refinancing debt crises that could be looming. it seems that a VIX sitting right around $12 to $13, it recently spiked up because it was as low as $12, is extreme complacency. And you normally see this complacency right before pretty substantial crashes here. But a lot of indicators are actually telling us that we need to kind of be aware. So want to share that with everybody. Hopefully everybody enjoyed, and we will see you in the next one.